In the wake of the successful issuance and oversubscription, really, of Kenya's first euro bond, the government here hopes that retail lending rates will now decline. That, at least, is according to Kenya's president, Uhuru Muigai Kenyatta. On Wednesday, he said that the Eurobond success should essentially reduce the government's plans to borrow $190 billion, 190 billion shillings from domestic sources. Kenya's government has outlined a raft of measures aimed at reducing retail interest rates. From the 1st of July, Kenyan banks are to use a reference rate set every 6 months by the central bank, using the central bank rate and the 91-day T-bill rate, an average of those two, to price future loans. Banks will also be obliged to disclose any premium that they place above the reference rate and to make a full disclosure of all bank charges to the public. Let's find out how exactly all of this will work. Habil Olaka is the CEO of the Kenyan Bankers Association. He's live in studio with me right now. Mr. Olaka, walk us through exactly how this bank reference rate will work and what the difference is between it and the current interest rate pricing mechanism that we have right now.
Yeah, thank you. The Kenya Bank reference rate that has recently been introduced will be computed as an average of the central bank rate, which is a policy rate, and the 91-day T-bill. And these are quantities that are observable in the market. So the average of that will be now the reference rate, and banks will be required to price their floating rate facilities on the Kenya Bank reference rate. Now, the difference between the newly introduced reference rate, which is the Kenya Bank reference rate, and the existing pricing mechanism in the banks is that banks have been using their own base rate, which is set internally, and therefore, in the eyes of the consumer, he is not able to compare pricing across the various banks. Now, with the new Kenya Bank reference rate, which is a common rate that will be applicable for all the banks that will be providing credit facilities, the consumer now will have a way of being able to compare different offerings from different banks, because they'll all be pricing it on the same reference rate.
Indeed. The formula, however, also contains another element, K, a premium that banks will be allowed to load on top of the average of the central bank rate and the 91-day T-bill rate. Will the 40-plus members of your association be obliged to explain how they arrive at that premium?
I think the whole essence of the mechanism was to ensure that there is as much transparency in terms of pricing as possible. And therefore, that's why there's a common reference rate. And then the intention is to have as much disclosure as possible on the K. Now, there are practical difficulties in terms of splitting to the level of detail that you indicate, where the K will have to be explained to that level of detail. I think banks will endeavor to try to explain to the consumer what constitutes the K, but it may not be practically possible to break it down to the respective components, because basically what happens is that sometimes, for example, if you have got cross products, you may have different ways of arriving at the K, and it may not be easy to disclose what components are actually put in the K. But I think the intention is to ensure that there is as much disclosure as possible to the
Indeed.
customer.
Let's talk about non-performing loans. In the first quarter of the year, between December and March, they went up about 16%. Are we seeing a ripple effect here of the massive rate hike that we had in 2011?
To an extent, I don't think so, because if you look at the reason why there was that effective increase in the non-performing portfolio component in the banking industry, most of it is attributable to specific sectors. And you'll see, like, for example, the construction sector was a major contributor. And if you drill down into the construction sector, you'll discover that most of them, especially the large ones, have got facilities or contracts with the government for which there was a delay in the payment of, for the contractors getting their payment back. And that has contributed significantly to the deterioration of the portfolio in the banking industry. You may say that part of it may also be because of the fact that the interest rates are high, given the trend from 2011. But generally from 2011, I think what you have seen is the trend has been on the downside. So since 2011, the rates have been coming down. So even though they are still high, but the trend has been more or less coming down. So I'll attribute more of it to the fact that the contractors, especially those that have been contracting for the government, have not been getting their payment in good enough time to be able to meet their obligations.
Indeed. Final question to you, Mr. Olaka. KBA is one of the respondents in a case in which a Kenyan national has essentially sued all banks in general, accusing you of levying charges without the consent of the finance minister, as per Section 44 of the Kenya Banking Act. Do your members have definitive proof that they did acquire consent to raise interest rates and charges in this particular matter?
This is a case that, the case you're referring to is a case that has been in court since way back in 2003. It went to the High Court, it then went to the Court of Appeal, then it has come back to the High Court, and the matter has been in court since. I think the only comment I would make on that is the fact that we have given instructions to the lawyer to defend the case. But given that the matter is now before the court and the issue you're actually asking is one of the issues that is being argued in court, I would, I think, be compelled under the sub judice rule not to comment specifically on the question.
Indeed, we'll have to leave it there for the time being. Thank you very much for your time this evening. That's Mr. Habil Olaka. He's the CEO of the Kenyan Bankers Association, live with me in studio.